Okay.
Well, good morning, everybody. Glad to be with you virtually this morning. Lot going on in the markets right now, a lot going on, politics, et cetera. So we've got plenty to talk about this morning. As Charles mentioned, we've got really three different areas to talk about today, not only the markets, but on government programs as well as crop insurance for this year. So let's dig right in. First off, we'll hit on the markets, what's going on today. I think the number one at the top of the list here over the last, 45 days has been USDA. We've had several surprises from the government. Go back to the January crop report. We had a significant cut in the final U.S. yields, and that really provoked this last part of the rally that we've continued to see here recently. We'll hit on that here in a minute. Also, exports, trade, tariffs. What's going on with all of that? We've had a good start to the year in the export business. Certainly, there's a lot of focus on the tariffs. You can see, Mexico, Canada, China, three big ones for us. Mexico really matters mostly on corn, Canada mostly on ethanol, China, soybeans, and cotton. So it is imperative that we were able to continue to trade with those countries. Here recently, we saw some discussion about the steel and aluminum tariffs. The EU punched right back and said, well, we're going to reciprocate with our own tariffs. Saw this chart the other day that shows, technically the EU already does. If you look at the tariffs they put on U.S. Imports, especially in meats, but beef, pork, poultry, etc., butter, cheese, milk, they have significant tariffs already on U.S. products. So not quite sure what they think as far as retaliation, but I would say they've already kind of done that. We'll take a look at the managed fund positions. It's been a roller coaster ride for the funds in and out of ag over the last few years. And then lastly, South American crops. Pretty important time of the year in the Southern Hemisphere. Brazil really going to crank up harvest here as we go forward over the next couple of weeks. In Argentina, still finishing the crop year out. It's kind of like mid-August down there right now, what mid-August would be here in the United States. So pretty important time to get some rain as well in that part of the world. So let's start out looking at the corn market. And if we go back to January 12th, the final USDA report, again, a big surprise. USDA lowered the final U.S. yield 3.8 bushel per acre down to 179.3. That is a record, but we still have not raised a 180 crop in the United States. So kind of keep that in mind. The red and the pink states were the ones that saw the biggest drops. So the Minnesota state yield ended up at 174. We do still have several states with records this year, the ones with the pound sign: South Dakota, Iowa, Illinois, Michigan, New York, down into Arkansas, Louisiana, all did have record state yields. When we look at the latest balance sheet, we did have a report 2 days ago. The government did not change any of the numbers. There were some people thought they might bump some of the demand figures for corn, but they kept everything the same. But I want to point out the big one here, besides production going down, was exports this year. That exports have reached 2.45 billion bushels of corn. That's where we were 3 years ago, but that's when China was buying U.S. corn, and they're not buying anything right now from the United States. So it's been the normal buyers, Mexico, Japan, Colombia, South Korea, that have been buying a lot more corn than what they normally would by this time of the year. So we'll see eventually. Some people thought the government would raise that number yesterday. They chose to leave it alone, ending stocks at 1.54 billion bushels. That is not tight, but it's kind of teetering on the edge. I usually figure 1.5 billion is kind of that line where if you get below 1.5 billion, then you get kind of bullish to the corn market. And so we've built some market up based on that and based on some thoughts that maybe the carryout really is going to be a little bit tighter than that. USDA did raise the average farm price to 435. That was up a dime from last month. Now, the only place this comes into play is at the end of the marketing year for PLC and ARC potential payments. So we'll use that price, like for the ARC program, times your final county yield to determine whether there was a loss of revenue in the county. But one of the big reasons we're seeing export business so strong is that we just don't have much competition at the moment. If you look at the other three major exporters, Argentina, Brazil, Ukraine, their stocks are going to be way down from where they've normally been. And the big one out of that is Brazil in the green. And a big reason for that is that Brazil government has continued to push ethanol production. So ethanol in Brazil is kind of where it was here in the US almost 20 years ago. They're going to continue to ramp up usage of ethanol, biofuels, and that's a good thing for us, right? Because if Brazil's using a lot more of their corn internally, then they've got a lot less to the export market. So that's been a positive here for the U.S. market. And one other way to look at this, if you look at the big four, US, Brazil, Argentina, and Ukraine, our stocks to usage ratio is amongst the tightest we've been at about 7.5%. But if you take the US out, those other countries now are at a 42-year low. So buyers know that if they need corn, they've had to come to the US. And that's what we've seen so far this marketing year. And that kind of shows you what the funds have done in the corn market. And it's been a roller coaster, but here's a snapshot of what they've done in corn futures over the last 5 or 6 years. And if you go back and look at the gold and the purple lines up at the top, 21 and 22, the funds had built huge long positions in the corn market, rivaled where they had been back in 2010 and 2011. That's the last time they had positions this large, up around 350 to 400,000 contracts long. Once we got into 23, what happened in 2023 was China stepped aside, quit buying U.S. corn. The big reason the funds bought was China. The reason they got out of the corn market was China. And so they went to the short side of the market. They recognized that U.S. stocks were going to start to build without that Chinese demand, and that, there was no reason to want to be long corn. And so they spent the entire 23, 24 marketing years on the short side of the corn market. Even as of last July, they were holding a record short position in corn futures. Then things started to flip. And I think I give credit to these funds for recognizing before USDA did what was really happening, that Mexico and some of these buyers were stepping in and taking advantage of cheap prices and really starting to load up. And so the funds quickly started buying back their short positions, got to even by 1st of November. Part of the next run was a rally in the oil market. Crude oil started to rally. And if you look at historical pattern comparison between oil and corn, they do tend to trend together very well. Oil rallied from $66 to $79 a barrel, and that drove funds to buy more corn. Then we had the January crop report. We saw continued good export sales. And these funds now have built their long position to 360,000 contracts as of last week. And so then the question going forward, of course, is what will the funds do? They're holding basically a top 5 position that they've ever held in corn futures. Do they want to continue to hold it? Do they add to it? Or do they decide to step aside? I guess I personally feel that, what do we have coming up in the corn market? We're planting the second crop corn in Brazil right now, which accounts for about 75% of their production. So I do think that the funds kind of want to see what happens there. I think that there's still some belief that the U.S. stock number is probably going to be a little bit lower. So it wouldn't shock me to see these people hold this position maybe on into spring, maybe until we get a confirmation of how many U.S. acres we're going to get planted this year. But, kind of like we saw in those years, you tend to see the seasonal pattern of selling as you get into late spring, early summer. And so wouldn't shock me to see a similar pattern again this year. And then, of course, it depends on U.S. production as we go forward. But here's a snapshot of March futures. Again, been a roller coaster ride. Had a big high back in May last year. Didn't get the summer weather rally that we all hoped for. We saw this huge influx of producers selling in late July, August, because we didn't have that earlier rally. Took us down to a new low. September corn traded all the way to 363 before we bottomed out. But the March contract at that time, we had this huge carry in the market. Nobody wanted corn. Finally, when the selling got done, we started putting harvest in the bin. Market rallied a little bit. We had some more harvest selling. Here in December, we started Thanksgiving at about 4.25. Then I think this was the oil rally that took us through December. Then you had the spike here from USDA January 12th. And since then, we've added another 25 to 30 cents to this market. So based on just strong demand. Um, I put circles around the bottom here on the chart. The green line is the relative strength index, and the red and the blue are the stochastics. And if you follow my heat check column in my market report each day, we identify which are the hot and the not markets. And these would have been times where we had corn in the hot zone, where we've had a little bit of a rally. The most recent, of course, lasted, for about 3 weeks. We had very strong corn market, and now we've kind of seen the market take profit a little bit. We stopped at the $5 mark. We're not quite able to get through it. Didn't get a bullish report from the government this week. So that maybe triggered a little bit of the selling we saw a couple of days ago. And right now, here we are hanging right at the 9 and the 20-day moving average. So kind of a sideways pattern. Can you break $5 in March corn? I don't know. It's going to take somebody to buy it. The funds are going to have to be the ones to do that. If they decide they want to get longer, I don't know if they do. You got a resistance at $5. You got resistance at 508 back in the May, where the May high was. I think this is a great place. If you haven't been selling corn on the run up, I think it's a good place to be a seller. The one couple of things I would mention though, number one is basis. We're seeing extremely wide basis levels right at the moment because there was a lot of corn got moved really from the beginning of January through the 1st of February. So I think the market is full right now. And that's also evidenced if you look at the futures spreads. March to May corn futures right now at 14 cents. That's 7 cents a month. Those are harvest type spreads. So what the market's yelling at us today is we don't want your corn now. We don't want it in March. We probably want you to hold it out into April, May, June. And so I do think there's better selling windows. If you were to sell corn today for hedge it on the May board, it's at 504 right now. So not a bad plan if you want to take advantage. And if you want to stay in the market, go buy an out of the money call option. Maybe buy a May call or a July call if you want to stick around in case this market trends higher. So looking ahead to this coming year, what's going to happen? I think most everybody's in agreement we're going to see more corn get planted. The question is how many more corn acres? I think somebody on X this morning said a gazillion more corn acres. So I don't know if that's going to happen, but we'll see. Informa Commodities came out last month with their estimate at 93.5 million acres. So that's my first alternative balance sheet number here. The second one, I said, what if we just flip back to last year? What if we switch corn and beans back? You go back to 94.6 million acres. I think that's easily doable given the price relationship between those two commodities. The third one I plugged in here was what if we go back to the 2012 record, which was 97.2 million acres? I don't know that that's possible, but I did read somebody last week that suggested we could plant 98 million acres of corn. So I guess there's nothing that's off the table at this point. Depends on price, depends on weather, of course, depends on input prices as we head into spring. But if you plug in I used a little bit below, I think what USDA will use for a yield. I used 181 and then ratcheted it down a little bit if we add extra acres. But that would give you total supply somewhere over 17 billion bushels. So we'd have a lot of corn with those acres. Now, I do think demand will be strong again next year. Feed demand, I don't see the feed numbers changing much. Ethanol demand, I think will continue to produce, right up at the top end of this thing. So exports, the other side of this, if Brazil's going to continue to use more corn domestically, I don't see either Argentina or Ukraine having a bumper crop to be able to ship and compete with us. So I think exports should stay fairly firm. So looking for demand over 15 billion bushels, but ending stocks would likely then grow, somewhere up around 2, if not a little above 2 billion bushels in the year ahead. So, of course, a lot of things are going to change. We don't have the acres in the ground yet. We don't have the yield, of course. But first of all, I think there is pressure. We need to get the corn in the ground. But if we do and get off to a good start, the potential is there to raise stocks in the year ahead. And so when we're thinking about acres, Susan Stroud shared this chart yesterday, looking at the corn bean ratio right now down to 2.2 to 1. Lowest we've been on this date in a long, long time. So, I don't know how many more acres of corn we're going to get planted, but I think there's going to be some intention to get it done. I know in parts of the country where you're at, for example, where we saw some switch to beans last year due to weather, I would assume we're going to see a lot of switch back to corn. In folks I've been talking to across the I-states have been telling me, yeah, we're going to plant a little more corn this year. I don't think anybody's going 100%, but I do think a lot of people are going to plant, that extra one or two or three fields that they may switch over. So I think it's going to be real. Question is, how big is that number going to be? USDA will have its planting intentions report out on March 31st. And that'll be based on producer surveys. So be pretty interesting to see what they come up with that day. So as we look at December futures, the market is trying to tell you that we want you to plant more corn. We've had almost a 50-cent rally off the low. You can see, well, a few things to point out here. If you look at the indicators at the bottom of the chart, we haven't had that many rallies in December corn. I was hoping we'd get back, when we were back here in December, I was hoping we'd get back to 450 and 460, which were basically these fall highs. And we were able to do that and now extend the gains. So I think it's a great place to be started, having some corn hedge for next year. Maybe not huge profit at this level, but I do think it's decent numbers for most guys. And if you are able to pump up another dime, sell a little more, chip into this thing if the market trends higher. But if you look at the RSI and the stochastics at the bottom of the chart, probably tells you we're due for a bit of a correction back to the downside. So, and if you're one of those people that likes to sell rallies, you look back at the number we've had this year, you just haven't had that many of them. So I want to take advantage of the ones we get. And if you look at the historical pattern in corn futures too, right now, this mid-Feb to early June window is usually our best window to sell corn every year. You've got December last year in gold, the 3, the 5, and the 10-year average of December corn futures. And, so I don't think any of us are going to sell 50% of the crop when we get to June 1st. So I do think we want to chip in and sell the rallies as we're going along. If you don't like just flat out selling, you want to do something to keep some upside, go back and look at our market report email from Monday. This is what I put in Monday, and we looked at some different scenarios using options, minimum price, buying long puts, buy a put, sell a call, basically a min-max, three-way option trades with a put and a call, and selling a put below the market. And then also utilizing crop insurance in the Ark County program. And we'll talk about all of that here in just a few minutes. On soybeans, if you look back at the January crop report, pretty similar to corn. USDA made a lot of cuts to the state yields. Overall, beans were kind of disappointing this year, ended up at 50.7 bushel an acre. We only had 2 states with records, and those were Arkansas and Mississippi. The Minnesota state yield ended up at 45 bushel an acre. And looking at the balance sheet from this week, USDA didn't make any changes other than the average farm price. They did lower it a dime to $10.10. Kept ending stocks at 380 million bushels. Now, that is down from where we had been a few months ago, over 500 million, but this is going to be a 4-year high. So, we're not going to run out of beans. We're going to have plenty of soybeans this year. The good and the bad on this balance sheet, the good is the crush number. We're crushing a record amount of soybeans each month right now. We've got several new plants that have come online over the last couple of years. We've got several more in line to come on over the next couple of years. That crush number is going to continue to grow. And it needs to, because the exports are where we're struggling. Even though this number is higher than last year, we're 300 plus million less than we were just 3 years ago. And we anticipate that number is not going to get bigger as we go forward because of the competition from the Southern Hemisphere. But go back to that domestic crush number. You can see last month, the December crush was a record high. We assume as we go forward, we're going to continue to break new records for each of these months as well. So we need that to happen for that extra demand because, as I mentioned, exports, we're running below the 5-year average so far this year. Probably seeing USDA keep that target lower. This morning's export sales numbers, I think we're 200,000 tons last week. You're down here pretty low numbers, and we anticipate that's probably going to continue on into spring. One of the big reasons that exports are struggling is China. You go back 10 years ago, China was this huge growth market for soybean imports. They were expanding, pig production, and they were, needing soybeans. And right now, they've been building supplies. They are loaded up, I guess you'd say, and don't really have that appetite for more soybeans. So when they do buy beans, of course, they're probably going to buy them from Brazil when they can. And so if you look at the big three production, the United States in red, Argentina in blue, Brazil in green. We're looking at the third straight record crop between those three countries this year. And even if you shave a couple million tons more off of Argentina, most analysts think the Brazilian crop's going to be a little bit higher than this. It's going to be a big, big Southern Hemisphere production coming on, and it's just getting cranked up. And looking at the latest weather forecast, it's going to help. Here is Mato Grosso, here in the center of Brazil. Mato Grosso raises as many beans as Illinois, Indiana, and Iowa. So it's huge. And they've been delayed getting started because of wet weather. The latest 15-day map out yesterday shows that's going to change. They're going to be dry for the most part over the next 15 days. That's going to really ramp up bean harvest. It's going to really ramp up double crop corn planting. So all in all, the forecast looks pretty good. And as you get further south, down into southern Brazil, Uruguay, eastern Argentina, they're going to still get some helpful rains that'll help finish the crops down there. So forecast-wise, things look pretty good at the moment. And so when you look at the big picture, ending stocks are expected to be at a record high this year. Almost 130 million metric tons at the world level. Again, that's easily going to be a new record. So I don't see anything that's going to change that at this time. And that's what's kind of separating soybeans from corn right now, that corn's got a tight world balance sheet. Beans have got this huge world balance sheet. And lastly, if you look at the comparison between U.S. and Brazilian soybeans, we've got the value of U.S. beans in pink, Brazil beans in green. This was just out a couple of days ago. U.S. beans are continuing to be priced way above Brazilian soybeans. Almost 90 cents a bushel for the next couple of months. As you get even out into late summer, and I think this is going to continue out into September, maybe October, that you're going to see Brazil have a lot of beans to ship, and their beans are probably going to be priced cheaper than ours. So it's going to be, I would anticipate fairly wide basis levels this fall on soybeans. So as you're thinking about making sales for new crop, be looking at basis levels. And if they're decent historically, then maybe it's a situation where you want to lock some of that in. So here's what the funds have done in soybeans. Kind of like corn, you go back 2-3 years ago, they had big long positions in this market. Eventually, by the beginning of last year, they went short the market following another big South American crop. But they've been back and forth on this thing. As late as September, they were still short 150,000 contracts. They bought a bunch of that back in the month of September, and that was driven by the palm oil market. We saw Malaysian palm oil production last year slip pretty sharply, and that brought a lot of buyers to the world market looking for soybean oil for human consumption. And when that happened, we saw big buying in the bean market. Then year after harvest, the January crop report, funds bought some more, ended up going long beans, about 60,000 contracts as of last week. Again, I asked myself, what will the funds do? And if I were a hedge fund trader, would I want to be long soybeans? Or if I'm a farmer, would I want to be long soybeans? And I guess my answer today would be no, based on the fact that South American harvest is really going to get cranked up. They're going to really start loading vessels, and we're going to basically get shut out of the bean market as we go forward. So I've been suggesting for a couple of months now that I wanted to be out of beans by the end of January. I still feel that way. I don't really see why I'd want to hold beans and compete with Brazil for the market. So the market has given us a gift of a rally. I think that the first part of this rally from 950 was maybe following the corn market. Second part of this has been USDA. But I think it's been kind of a gift. And so I want to take advantage of it, sell my beans. If you want to stay in the market, go buy an out of the money option or something. But again, look at the indicators at the bottom of the chart. We had beans in the hot zone for a couple, 3 weeks, and now here we are chasing back to the downside. So in fact, quickly moving towards an oversold market, but probably still more room to go down. But at the moment, we're holding the 100-day moving average, 1023. We'll see if that lasts into the weekend. Then you got the 50-day moving average at 1018. So we'll see if those two can provide support. Looking ahead to new crop, what can happen this year? Well, I put three scenarios on here. The first is using USDA's baseline projection of acres at 85 million. The second would be using last year's number, just flipping corn and beans back. So you'd have beans at 83.6. And then the third would be is if we'd planted a record corn number, then we know that beans would drop back significantly. And so if I use a trend yield, you're talking production total supply 4.74, somewhere down to 4.5 billion. Demand, I think crush demand is going to set a record this year again. I think exports are going to slip back a little bit because of the size of that Brazilian bean crop and the amount that they're going to sell into our marketing year next year. And so I can, see a situation of a 500,000 more bushels or the same or even a little bit less if we really, really cut acres. So I don't know that any of these are big market movers per se. I do think that really South America is going to continue to drive this bean market as we go forward. And how many acres does Brazil plant next fall? I think that's going to be an important factor. And I would look for them to still continue to ramp up acreage. I think that most of that acres is coming out of pasture. It's not virgin ground. It's coming out of pasture, and their government is continuing to encourage guys to do that. So as we look at November 25 futures, again, it's been a nice rally, a buck off the low from back in December. We got to the 200-day moving average for the first time since May, and then we just ran out of gas there, and now we backed off about 30 cents. Still, I think this is a great place. I'd want to be starting selling some beans for next year if you haven't yet. And depending on what your acreage situation, maybe you want to get somewhat aggressive here hedging beans. I think this having a 10 in front of this is a lot better situation than I thought 2 months ago. And if you look at the number of rallies, you just don't see that many. So even though the market's off the high, I still think it's a good sale. And if you look at the historical pattern in bean futures, really from now through May is your best window to sell beans. 3, 5, and 10-year average. Little different looking than what corn is. One of the biggest differences that beans have is that we have a harvest every 6 months, a major world harvest every 6 months. And so that pattern's flattened out a little bit. But this is our best window to be selling. So I want to sell the rallies as we get them here, Feb, March, April, and into May. So thinking about 2025 and how we're going to strategize for this year, we've talked about the grain marketing piece of the puzzle. My goal with NAU Country is how do we blend that together with government programs, with crop insurance, hopefully be able to build us a solid plan for the year. I think with this rally that we've had in the last 45 days, we've got some chances now. If you go back to December, it was looking pretty bleak, but I think things have looked a little bit better with where we're at today. So primarily on the crop insurance side over the next couple of weeks or so, we're going to be talking about these three items: revenue protection, supplemental coverage option, and enhanced coverage option. Then at the farm program side, once again, we did get the extension of the 2018 Farm Bill, which means once again, we get to choose between the PLC and the ARC programs. So if you forget what those programs were, RP, revenue protection, is based on your farm's APH, and it covers up to 85%. SCO, supplemental coverage, it's a county coverage that stacks above RP, starts at 86%, and covers down to your individual level of coverage. If you're already buying 85% RP anyway, you might not want to mess with SCO for 1 point. Then ECO is starting at 86 and goes up to 90 or 95%. I'm calling this the blue light special trade for this year. Any of you Kmart shoppers, ECO, the government came out, the one change for crop insurance this year, they raised the copay. I'm not using the S word. I'm calling it a copay. The government raised their copay rate from 44 to 65% on ECO this year. That was included in a spending bill this last fall. Any of these policies that are above 86% are basically not included under the Farm Bill negotiation. So they were able to step out and make that change. That's something we've been asking for a few years now. And I think that's going to be a game changer for a lot of folks. It's going to cut the cost on corn about $10 an acre versus last year at the 95% level. Soybeans are going to be about $6 cheaper at the 95% level. So again, I think that's going to be a real game changer for looking at ECO this year. Then at the FSA office, the PLC program is just price protection. Doesn't matter what you do on crop insurance. If you think the markets are going in the tank next year, you can sign up for PLC and it's going to give you price protection. Then the Ark County program is a county-based protection. It starts at 86%, and the max of that band is a 10% band. It cannot be added with SCO. So producers would have to make a decision. Do I buy SCO or do I sign up for the county ARC program? You cannot do both. So to me, that's the first decision you make this year. One important factor, PLC and ARC both protect 85% of your base acres. Doesn't have anything to do with what you plant. Those are 85% of your base acres. So I think this year is probably as critical as any to look at your base acres and review those and see how those match up with what you intend to plant this year. If they do, then Ark County, for instance, could provide you some decent risk management. If you've got 100% wheat base, for example, and you're going to plant a field of corn, then that's not going to do you much good. One thing to consider is that these are field or farm by farm, crop by crop decisions. So you could buy SCO on one farm, sign the rest of them up to county ARC if you wanted to. So to me, it's kind of like a ladder this year. How am I going to build my ladder? Where do I want my rungs? How many rungs do I want? What am I going to do with my individual coverage? How high up do I want that protection? The second part of this then is ARC versus SCO. Does it make sense to buy SCO, or do I want to use the county ARC program to get that middle rung? And then, am I going to do something up at the top end? Does it make sense? Do I need that extra coverage this year to get my cost of production covered? Can I do that with ECO, especially at the added discount? So that's kind of how I'm looking at this year. How high do I want that top rung to where I'm going to get off the ladder? And so I think it starts with prices. And we've got a completely new deck of prices this year to look at, and that's going to help me determine what I want to look at for a program. And the PLC program is going to use the numbers in blue. So PLC, the corn price is going to bump up to 426. Beans are going to bump up to 966. Wheat's going to go to 556. You can see the other numbers down below. Those numbers are increasing because the county ARC prices are going up. And there's a multiplier involved that helps pull PLC with it. The county ARC price benchmarks are going to be in red. So we're going to take corn up to 503, beans to 1217, wheat's going to jump to 672. That's the highest the corn number's been since 2015. And I know there's been a lot of discussion around the country this year about needing a new farm bill. I, quite frankly, was telling people, no, we don't. We're finally getting the benefit of the county ARC program the way it was written, because it was written to be a counter-cyclical type program. And this year, this 5-year Olympic average, we're dropping 2018's price off and bringing 2023's price in. And so now we're getting a better price while the commodity markets have been going down. These ARC benchmark prices are going up. So I think it's a fantastic year to still have this program in place. Be careful what you wish for. If we get a new farm bill, we don't know what's going to happen. So the first decision I make then is, do I buy SCO or sign up for the county ARC program? Well, SCO is going to use the crop insurance prices that are currently being set. I think corn now is up to 469 as of last night. I think beans are down to 1060. But either way, if you compare ARC County to SCO, I favor the ARC County program this year, as long as you have base acres on your farms. If you don't, then ARC doesn't do you any good. You might still look at SCO on certain farms. But this year in particular, ARC County does look to have a pretty good advantage. And so we built a calculator. This is we have a tool on our agent portal called the Producer Profitability Matrix. I added this tool to it this year to be able to do a side-by-side comparison of SCO versus ARC. But we also know that if you decide to enroll or buy SCO coverage, you would have to sign up for the PLC program at FSA. So I've combined those together. So on the left-hand side for SCO, when I put this uh, example together, I used a 467 base price. The ARC price was 503. It's still the same. And I'm going to assume that we have a price drop at the end of the year, that the harvest price and the market year average price both go to $4.20. For SCO, I'm using 11% of band of protection just for to show how kind of apples to apples with ARC. Most of you probably have higher than a 75% coverage level. But if we did have an 11% band, that band would be worth $102. On the county ARC side, 503 times I used a 190 county yield. That would give us a 956 benchmark. One thing about this benchmark, if you take that times 10%, that's the most that the county ARC can pay. So $95 an acre. Let's go through the loss calculation on SCO. And I'm assuming that the county yield doesn't change. I just used a generic county yield here. So if we stayed at unchanged, but the price went from 467 to 420, that's only about a 10% drop. And since SCO is an 86% trigger, a 10% drop in revenue would not trigger any SCO payment. However, if the harvest price goes to 420, you would be 6 cents below the PLC reference price. So in this example, PLC would pay me 6 cents times my payment yield at the FSA office times 85% of my base acres. And in this example, I said that we planted 1,000 acres and I had 1,000 acres of corn base. I guarantee none of you probably match up quite like that. But if this is the case, I would get a $10,000 PLC payment, but I would have to subtract my SCO premium. Net, I would make $1,000. On the ARC side, because of the drop from 503 to 420, even if the yield stays the same, we would trigger a loss of $24. Take that times 85% of my base acres, I'd get a check for $20,000 at the end of the marketing year. So the way I look at it today, that 503 is still advantageous versus what the SCO price would be. I still look to sign up for the county ARC program. Now, where would that not work in my favor versus SCO? If the price were to drop, but the yield in the county were to jump, say 15, 20 bushel, ARC does not have a harvest price option built in where SCO does. But if you're already buying individual coverage up to 80 or 85%, then the ARC County program just makes sense for me this year. And same for soybeans. If I look at a similar example in soybeans with a price drop, because we're starting at 12.17 on the county ARC, in this example, if we went to 950 at the end of the year, then you're looking at almost $50,000 for the county ARC, whereas the other one, you're just barely squeaking by with not much of a payment. So anyway, I look at it, the county ARC looks like it makes the most sense this year. Now, again, every year we got to look at this thing. We might get a new farm bill next year. If we don't, even if we get an extension, some of the prices are going to change. So this is a year-to-year event right now. So as we look at our producer profitability worksheet, this tool I use to kind of put it all together. And so I look at crop insurance on the left. I look at my expenses up here in red, forward selling in green. If I want to add dollars for PLC or ARC, I can do it here in blue. And I used a 200 bushel APH. I realize a lot of you are probably a little better than that. And I use $900 an acre expense load. So your numbers are all going to be different. And that's why it matters to put your numbers into the equation, into the math. But the first thing I looked at is if I add an 80% RP policy, pay the premium on enterprise units. This year, 80% is most likely not going to be enough coverage to lock in to guarantee profitability. If you go back 2 years ago when we had 654 as the base price, 80% coverage could probably do it. 85% is probably not going to get it done this year. You can see down in the matrix, we've got yields across the top. We've got harvest price on the left-hand side. If we have good yields and good prices, we can make money. And if we don't, if either or both of those slip, you could be in a potential loss situation. We've limited our loss with 80%, but we haven't guaranteed ourselves a good year. So the next step I want to do, I think I'm going to sign up for the county ARC program as long as I got base acres. And then B, I want to look at ECO. An ECO is going to allow me to get a 95% county trigger on up above what I do on my individual coverage. And because of the added discount or copay from the government this year, it's going to be a lot better deal, a lot more palatable. Now, you can see in the example I used that 95%, even adding the county ARC, still not maybe enough to guarantee that I'm going to make money this year. It does change some boxes in the top left part of this matrix to green. So it does improve my situation greatly. But the other side of this is if I think downside on price is my problem, then I probably need to be looking at making some sales. And in this case, if I were to sell half of my expected APH at 475, which is not very far from where the market's at today on the board, then you look at the matrix and we've got mostly green. You've got still a few pink ones over here where we have a bushel loss and the price doesn't change. But it's improved my situation greatly. This is so much better looking today than it was 2 months ago at this time. And so I do think that, this situation is going to cause a lot of people to maybe switch from beans to corn this year. So we'll see what eventually happens. But I do think you need to use all pieces of this thing. And now's a good time with the rally we've had. Utilize the crop insurance side, utilize the farm program side, and also take advantage of the market to be making some sales here over the next 90 days. And so to me, it boils down again to how am I going to build my ladder? Where do I want the rungs on the ladder? How many rungs do I want? How close do I want this top rung to the top of the ceiling or the roof? So those are the things you're going to decide over the next couple 3 weeks. And I think that to me, I've got less questions, I think, this year about risk management that I have in several years because of how the county ARC prices have laid out for me this year, the added copay from the government on ECO. I think it's shaping up to, at least from the risk management side, to have less questions as we go into 2025. Don't forget, I know several of you are on my market opening bell call, the market report email letter. If you're interested in getting any of those, please let us know. The aftermath webinar I do every month, the day following the USDA report. We recorded that yesterday. It's out on our YouTube channel as well as our Thinking Cap videos. I did one on ECO a few weeks ago. So I would encourage you to go out to YouTube, type in NAU Country. You can check all those out anytime you want. And subscribe if you want to get notified when we post any new ones. So that pretty much covers it for me this morning. Appreciate your time. Hope you have a great rest of your meeting and a great meal. You all have any questions?
All right, Rich, it looks like you did a great job. There are no questions.
Well, if you do, feel free to shoot them at me down the road. So appreciate that.
Okay, and Rich did record this, so we should be able to get that if you want to review it. So, all righty.